Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update for the week ending September 25th, 2020. This is a weekly chart of the S&P 500. So you can see down 4 weeks in a row. That hasn't happened since August of 2019 when we had kind of a scare over the trade war. In any case, it's payback for August of this year where we saw that massive melt up speculative rally in mega caps. As you can see, the month of August here, that's been completely retraced as of this week. And that's all been about these mega cap FANG stocks like Amazon over here. So you remember they just got this big melt up in August, and that pulled the whole market higher just because of their weight. So you can see they've been the ones who've gotten hit the hardest. A lot of traders were chasing this. Amazon rallied 11.6% in August. It's fallen 16% in September. That's the 50-day moving average. So it did not hold up there. Google rallied 16.5% in August. You can see it looks like it's going to go parabolic over here. And it has lost 18% in September, broke right below that 50-day moving average, sliced through it like it was butter. And here we are down at the 200-day this week. And here's Apple. It has given up 20% in September since this bearish engulfing candle. So a lot of people are learning an important lesson, and that is that stonks or stocks don't only go up, as we've heard from Dave Portnoy for a long time. But I understand. I was in this same spot in 1999 when I first started trading, and the market was going up, and it felt like it would never go down again. But the fact is, the market is two-way. And from my experience, the more confident, the more arrogant you get, and you feel like you found something, some system or some indicator that you can't go wrong with, you're on a hot streak. When you get to that point and you're feeling invincible, that's about the time you're about to get your butt handed to you. But really, we've talked about this change in character, and this is QQQ on a 60-minute chart, and this channel that has been in place since basically late April. It's been a really steady channel. And when you see a change in character like this moving above the channel, I call these channel busters. Changes in character tend to precede changes in trend. So you had this nice, steady, stable channel. Here you can see it going back a little further. And this is that melt up. In any case, we got this kind of channel buster. Remember, I shorted it right here and then shorted it right here. Channel buster theory is when it breaks out on the upside of a really well-established channel. It's a change in character leading to a change in trend. And typically, they don't just pull back to the channel, they break through the bottom like we see over here. I have to say, it is interesting where this sell-off took place. I've been pointing out this broadening top in the S&P 500 for quite a while, and let's just get a little closer to it on a 2-day chart, actually 1-day chart. So where this whole sell-off started is 1 day after price reached the top of this upper trend line of this broadening formation. Broadening formations are a depiction of chaos. You can see higher highs, lower lows. It's a chaotic market. It's not a typical bull market. This is what a bull market looks like. Not a lot of volatility. It's trending nice and calm. It has pullbacks. They're not too big. You look at these swings, each sell-off is bigger than the next. I think this one was around 10%, then we got into 20%, 30 some odd percent. So that's a broadening top. It's a chaotic market. Take a quick look at the daily charts. This is SP 500 on the daily chart, 50-day moving average, and 200-day, both simple moving averages. So down 0.6% on the week. It was pretty ugly, just cut right through that 50-day moving average. Actually ended right below it the prior Friday. So a little bit of an ugly close and ugly start to the week. 4 weeks down, that has not happened even during the crash. Here's the crash earlier this year. We had 2 weeks down. We had a consolidation, a flag over there, another 2 weeks down. So that hasn't happened since basically August, which was kind of peak recession fears of 2019 back over here. Notice on this weekly chart, we do have a hammer. So it did close off the lows of the week. So that's a little bit more constructive. And it actually did so right here at this year-to-date unchanged mark for the S&P 500. It did dip into the red briefly for the year this week. The median stock is down almost 20%, 18.5% on the year. Here's the Dow, down 1.75% on the week. And again, it's just a very bearish price pattern. You can see the initial sell-off 3 days down, get a consolidation over here, similar to a bear flag, wasn't quite, and then another leg down. So 4 weeks down below the 50-day moving average. A lot of times technical buyers will buy there, but it sliced right through on Monday. And again, on a weekly chart, 4 in a row, and a little bit of a hammer here. So that's a little bit more constructive. And here's the daily chart for the Nasdaq 100. Actually up 2% on the week. It was the only major index that was up on the week. And since it has been leading to the downside, it tells me maybe that this mega cap selling in the mega caps is kind of drying up a little bit. Here's small cap IWM. This was actually the best performer last week, and traders got excited, CNBC guests got excited that because they were selling in those mega caps and that small caps had held up really well the prior week, that was a sign of rotation from the secular growth stocks, the mega caps, which are a little bit more defensive play, to the cyclical stocks that are very economically sensitive. Those are the stocks you want to see outperform when you're coming out of a recession and you're starting a new economic cycle. And those are the stocks that have not performed well. Small caps were the worst performing on the week, down 4.5%. So that rotation just completely failed Monday morning, and they caught down to what every other major average had been doing. So the little bit of relative strength over here was just completely washed out. That's the 200-day moving average, by the way, closed above it on Friday. But the bigger point I'm really trying to get at is that hope that we'll see this rotation coming out of the mega caps and into the small caps or into the cyclicals, and it just hasn't happened. Okay, this is a 30-minute chart of the S&P 500. Just going to quickly discuss the week. This upper trend line here is the February record high for the S&P 500, and this is the year-to-date unchanged mark. Let's take a little closer look. Here's Monday. Okay, just selling off real bad. Actually went long the market right over here late Monday afternoon and had a really good run. I went long with some UPRO shares and some UPRO calls. Those calls were up like 80% over here, but I expected one more day of a bounce because the market was so oversold and still very oversold. But what happened over here on Wednesday was just everything got sold. And I mean everything, whether it be stocks, whether it be bonds, gold, silver. What started the sell off was the mega caps. So that may have been the final flush in the mega caps. Luckily, I closed out part of that long position, took a 2% loss on the UPRO shares. I held the calls and actually made a 20% profit on them late Friday afternoon. I did sell them. But you can see what's going on here, holding this year-to-date unchanged mark. So a little bit of technical support there, maybe a little bit of washout as far as the selling in those mega caps. The only thing that didn't get sold over here on Wednesday was the US dollar. And what caused the market to sell off this week? It's the US dollar. So I want to just show this to you because moving forward, if you get the dollar right, you have a very high probability of getting the market right. So this is a daily chart of the US dollar index. And I just want to point out a couple key features. This is selling off with the market over the COVID fears and everything. And this is where the market was really crashing. This was a flight to safety in the dollar. It was a dollar shortage globally. The Fed had to deal with that by opening up multiple swap lines across the globe. And what the Fed was trying to do was stabilize the market. And to do that, they had to get the dollar to break. Okay, so this basically is the end of the March sell-off in stocks, the crash. Since then, the stock market has rallied, right? And the dollar has come down. So the dollar coming down has been very helpful for stocks to rally. A rise in the dollar, conversely, at this point is negative for stocks. So we're going to take a closer look at this area. This is a 30-minute chart. So here's the dollar index making lower lows. Over here, we see higher lows. That is your first clue that there's possibly a change in trend. And then we can see this little bullish triangle. It's bullish because we have a preceding up move right here. We're going to zoom in on this. And this is a 15-minute chart. Here's that trend line, that downtrend. Here is that little bullish consolidation. This is the start of the week. This is Monday. This is a breakout from that consolidation. It's a breakout above this trend. This is what caused the market to sell off. You may be asking, well, what does that have to do with stocks? How do you know? And let me just give you a little bit of a warning. The dollar's relationship to the market is fluid. There's about 3 different relationships. It changes often. What we're looking at is the S&P 500, and down here is the S&P 500's 90-day correlation to the US dollar. So over here, it's a positive correlation. Over here, it's a negative correlation. This is the crash. This is the rally. And you can see as the market rallies, this correlation is getting stronger and stronger and stronger. It's an inverse correlation, meaning the dollar goes down, the market goes up, and vice versa. Over here, it's 93%. It was at 95% just a week or so ago. That's very high. That's basically the highest it's been in years, maybe even a decade. Let me show you another way to look at it so it makes a little more sense. It is a 30-minute chart. This is S&P futures in the candlesticks. This is the beginning of September. This is the beginning of the sell-off for the S&P 500. This blue line is the US dollar index, except I inverted it. I flipped it upside down. That means the blue line going down is the dollar going up, and that is weighing on stocks. So you can see it actually led the market lower over here. And if we look, we come into this week. Here's Sunday, the start of the week, right? Remember I said the dollar broke out of that triangle? So that means this is where it broke out. So it came into the week before the market even opened on Monday, already moving higher, breaking out of that triangle, putting pressure on futures, S&P futures. That caused that really nasty sell-off on Monday. And we had another one over here on Wednesday. Dollar was still heading higher. You saw what I showed you. Dollar's been up all this week. We did get a little bounce in the market on Friday, and that's where I got out of my calls, made a little bit of money, but notice that the dollar is still at the high of the week. Gold got slammed this week. This is GLD. It was down 4.5%, had a really nice bullish consolidation going on here, and this is this week. So it did fall below it. It's not destroyed the consolidation, it's still there, but I think prices do need to stabilize a little bit. Let's take a look at silver. It got hit even harder. This is SLV, the ETF for silver. It had a bullish consolidation here too. So this is the week. Dollar went up, silver got slammed. Dollar broke out actually out of a triangle, right? Silver broke down out of a triangle, 14.5%. The short-term price action hasn't really stabilized here. It's an area that I'd watch for it to stabilize. But like I said, you have to get the dollar right to get all these other asset classes. Back at the weekly chart, the S&P 500, like I said, we have a bullish hammer right here, and that is at the year-to-date unchanged mark for the S&P 500. Nasdaq 100, that had been leading the market lower. Remember, the Dow, the S&P, they're down 4 weeks in a row. That had been leading the market lower, closed higher this week. So it's possible that that selling in those mega caps is starting to dry up a little bit. Small caps really broke down. They were very ugly this week. They caught down. If you look at an intraday chart, like a 30-minute chart here of IWM, you can see the price trend is very ugly. It is a bunch of lower highs and a bunch of lower lows. So that is really the definition of a downtrend. We still have some very bearish price action in some of the averages, like small caps here. There really wasn't much of a flight to safety or a panic in like the traditional safe haven assets. As a matter of fact, coming into the week over here, one of the reasons I went long the S&P 500 right in this area was because of the relationship of the safe haven Japanese yen versus the US dollar. Back to this chart of S&P futures, I've changed this from the dollar to the US dollar Japanese yen, USD JPY. It's not inverted. Here we come into this week where it's leading higher. Here's a little closer look. So the market is selling off Monday. USD JPY is actually leading lower on Monday, and then it bounces. We see the market bounce with it. We get this nasty sell-off, and USD JPY stays elevated up here around 105.50, which is exactly where I thought it was going to bounce on Monday. And you can see the market kind of reaching up towards it on Friday. And here's USD JPY on a 30-minute chart. All these little declines and bearish flags, all of these led the market lower. So it would happen a day before or an hour before, but it was leading lower. This is coming into this week. So this is the bounce. This is one of the reasons I went long the S&P 500. And I thought it was going to bounce right up to 105.50. So what I had said a couple weeks ago was below 105.50 was escalating risk off. Okay, a big flight to safety. The market's going to get nastier. So we're right here at this kind of neutral level, 105.50, at least for now for this trend. So if you see USD JPY heading higher, it's a little bit more bullish for stocks. And if you see it turn down lower, you're getting back to more of a flight to safety. It's not as key as the US dollar. The correlation between the S&P 500 and USD JPY is nowhere near as high as it is with the dollar. So the dollar is the first thing you want to look at, but a lot of these other currencies are telling us a lot. The market is super, super oversold. This is an hourly chart of the S&P 500, and this white line is the 13-week new high, new low ratio of NYSE stocks. And when it gets down here below like 30 or 40 or so, it gets oversold. And typically you'll see a bounce or a short squeeze. So you can see almost the entire month of September, it has been in really deep oversold territory that we haven't seen since the crash over here. It actually made the lowest low of this whole sell-off this week. So very deeply oversold. I hate opening new shorts into a market that's this deeply oversold. This is a massive short position in Nasdaq futures, even higher than back here at the kind of peak of the financial crisis. I think the highest since 2006. So you saw this major flip as the market came down. Traders, again, just like August, they're chasing it up. Now they're chasing it down. They have a massive short position in Nasdaq E-mini futures. Between that, the hammer on the weekly chart, the deeply, deeply oversold conditions, I would expect a bounce. But what you need to get that done is some cooperation from the dollar. And here's the dollar index on a 10-minute chart. So basically a pullback or at least a consolidation kind of going sideways. This is this week. There's nothing wrong with this price action. It's still very bullish. However, there is one thing I want to point out. Let's go to a daily chart. This is that really bad sell-off in stocks where the dollar was bid. It was big safe haven move to the dollar, right? So you can see where that started right over here around March. That's pretty much where prices are right now. So that could be an area of former support becomes resistance once it's broken. So we may see some resistance here. It may give the dollar a chance to pull back, stocks a chance to bounce and get out of that deeply oversold condition. And I would imagine that if they do get a decent bounce, we'll see a big short squeeze. So I want to be careful about entering new shorts here. I do want to use a big bounce to enter new shorts. One final thing I want to mention that was really, really ugly this week. And what this is the S&P 500 on a 2-minute chart in the red and green candles. And the white line is an equal weight index that I created of different credit assets. So high yield credit, investment grade credit, leveraged loans, stuff like that. It's risk sentiment. So you can see they did lead the market lower over here, making a negative divergence. This is the top in August, and this is the September sell-off. But as we came into about mid-month, you can see a higher low over here. And this is where the market kind of just goes sideways. And for members, this is kind of where I was hoping we'd get that whimper rally over here to get a good short on. And I was hoping that we'd get that with credit breaking down. But instead, credit broke down right here Monday morning on this sell-off. This is where prices broke below and kind of ruined this setup. But the point is, really ugly action. And then again on Wednesday, when I said everything got sold on Wednesday, including credit, really, really ugly. So we'll want to keep a really close eye on this. A lot of times credit will move because rates change. It's not moving because of that. Yields are pretty much flat, just down a teeny bit on the week, which wouldn't hurt credit anyway. This is risk sentiment. So this is risk sentiment, professional traders getting very nervous. Just one final thing I want to show you. It doesn't have to do with next week or anything. It's kind of like a bigger picture view of the market. So here's the Dow Jones currently on a daily chart with a 50-day simple moving average. This is the crash earlier this year as the economy shut down. This is the bounce back. So one of the things I had been saying was, there's a good possibility that this turns into a bear market rally or a counter trend rally or a suckers rally. I know it doesn't feel like that, but I want to just show you for context the 1929 crash and initial bear market rally. And this is the Dow's 1929 crash. This is the initial counter trend rally over here. Notice the 50-day moving average. Here's the Dow now, and here's the Dow back then. A lot of other similarities too. This counter trend or bear market rally for the Dow back here in 1929, 1930, that's a 48% gain over 21 weeks. The Dow now, that is a 56% gain over 23 weeks. Remarkably similar. Let me just show you what happened next. Here it is, Dow 1929, 1930, and I'm just going to roll this chart forward. We're going to go right into 1932. And I think we get a bottom right about there. Now let's take a look back. That's the original crash. That's the counter trend rally. This is over an 88% sell-off. Okay, so this is where that counter trend rally that we're just looking at right now ended, and this is what happened next. So when people tell you stonks only go up, they don't. And I'm not saying that this is going to happen, but what I am saying is that you could see how remarkably similar both counter trend rallies were, how remarkably similar they looked, how long they lasted, how far they moved. So I'm just saying be open to the possibility that that is a counter trend rally or a bear market rally, and not that it's the start of the new bull market. And on that cheery note, I'm going to wrap it up, everybody. Have a fantastic weekend. Don't forget to slide by the website. You can sign up for free posts. You can also check out becoming a member. Follow me on Twitter. I have a link below. And please don't forget to give the video a thumbs up if you liked it. And if you have questions, comments, please leave them below. I always try to get to them.